And with that, we'll also be getting started. I am Ananya, your host today, and a fellow Dreamers and Doers member. By day, I'm Chief of Staff to the CEO at Incandescent, and I'm also an investor across several communities and funds. I'm super excited to dig into today's conversation around wealth, investing, and how our financial strategies can evolve as our assets grow. We're very lucky to be joined today by Linda Du, who is the co-founder and CEO of Moola Money, which is an AI-powered financial planning platform helping people make smarter financial decisions and build long-term confidence with money. Linda is also the founder and managing director of Okta Investment, recognized as Germany's best alternative investor in 2025, and previously advised leading banks and wealth management institutions at McKinsey and Company. Today, Linda is going to give us a window into how high net worth individuals, family offices, and sophisticated investors think about managing and preserving their wealth, from liquidity and private markets to tax-aware investing and risk. Whether these strategies are relevant to you right this moment or simply something you want to have better understanding for in the future, my sense is this is going to be a really valuable opportunity to expand our own financial fluency and the possibilities that we know are available to us. Linda, we're super grateful to have you here with the Dreamers and Doers community, and I'm excited for us to jump in. I'm going to turn it over to you. And for folks who are here and joining us just right now as well, I'll be sending over a little bit more information in the chat about how we're going to operate, but we'll have plenty of time for questions and answers from your end. So definitely encourage you to think through what is most on your mind and what you're curious about. And with that, Linda, I am super excited to turn it over to you.
Thanks so much for the lovely introduction, Nanya. I'm just going to start my screen share. Okay. And so, yeah, oh, here we go. There we go. And yep, so as Ananya mentioned, I've been working in finance for most of my life. And so that includes like a very corporate background, but it also includes stints, for example, at Kiva, which is a microfinance peer-to-peer distributed lending platform. And so I've kind of seen a broad spectrum of the ways that different people's manage their money. So be it, micro entrepreneurs from Zambia all the way through to ultra high net worths and family offices. And so something that I was really interested in is how big of a mindset shift is as you kind of operate in the different levels of personal finance and personal wealth. So the way that you would manage money on different income levels, but also different asset levels changes quite a lot. And so I started Moola at the start of last year, actually. So it's been about a year and a half now. And my reason for starting Moola was that a lot of my friends had seen that I was doing quite well with my investments, and were asking me for help with their financial planning. And so basically, I took a look around and I saw that there was nothing really out there. So I basically took the enterprise grade financial modeling that I was doing at McKinsey and then applied that to household and individual finances. But throughout that, what I found really interesting was that even though we were building tools to solve this problem, there was a lot that came down to the psychological relationship that people have with money. And so whenever we talk about money, like at the end of the day, like money itself is quite meaningless. It's just numbers on a screen. But the way that we manage it and the way that we relate to it says so much about our individual experiences with it. And so actually trying to create behavioral changes is probably one of the toughest things about financial coaching and wealth management. And so with that, so this is the second workshop that I'm doing with Dreamers and Doers. So the previous one I did was around basics of investing. That was around 2 years ago. And so this one's a little bit more about, okay, so what about when you've learned all the basics? Where do we go from here? And so, and just a heads up, by the way, so because I'm screen sharing, I can't see any comments. So, if you have any questions, feel free to jump in. And if there are any comments I should know about, feel free to voice them out loud. And so, yeah, so basically, when it comes to the basics, like the first part of financial planning, I think all of these levers are things that you're probably quite familiar with, right? So you start out with the budgeting, so making sure that you have enough to cover your expenses. Then where do you go from there? Let's make sure that you have enough to cover unexpected things like medical bills or deaths or divorces. And then after that, okay, so now that you've sorted out your working lifetime, let's figure out your post-work lifetime. When can you actually retire? And then after that, you get the opportunity to grow your wealth through investments. The most common vehicle, which I think is also a great vehicle, being ETFs or exchange traded funds. But then after you've done all that, all of the sensible things, the playbook things that people tell you to do to grow your wealth, beyond that, it goes quite quiet. And there are more levers out there, but they tend to be kind of reserved for, or their perception is that they are reserved for people with a lot of net worth. And actually, something that's really nice is that financial markets are becoming much more inclusive. So, just one example is, the stock market. It used to be, I have this book from the Financial Times, which is about 20 years old. And it was talking about how in the London Stock Exchange, people used to just walk around trading floor, shouting out orders. And so you wouldn't be able to, as an individual, maybe 20 years ago, as you started being able to like buy stocks and sell stocks on the internet. But before that, you wouldn't be able to, as an individual, buy or sell individual stocks. And now not only can you buy stocks, you can buy ETFs and all of these wonderful financial instruments we can start to access on our phone. And the same goes for these more complex financial instruments as well, which I'll go into a bit of detail in how people like you or I can start investing in things like private markets. So one thing is that, as we went through that ladder previously, the question that you're answering at each stage becomes quite different because, it's almost like the reverse Maslow's hierarchy of needs. But then after you reach like a certain stage of stability or a certain point in your career, the questions that you as an individual might be answering for is quite different. So if I take a couple of examples here, if you're a founder, you might be familiar with the concept of paper money because you might have raised a round of investment at a specific value. And so technically, you have shares in your company worth a certain amount of value, but that only makes sense if you are able to exit that investment. Similarly, with an executive, you might have your own investment portfolio, but then you might also have stock options which are tied to your company. And in that case, again, like you're not super diversified because all of your wealth is still tied into your company. Investors, so maybe you want to just diversify into different types of investments, but maybe you've run out of capital to deploy. And then you might also be an exited entrepreneur. So then you might just end up with what feels like a windfall. You might end up with a bunch of cash, and then you're just like, well, I've been cash poor for the past 10 years. What do I do with this cash? So the questions and the issues that you might be answering for in these different circumstances will be different. And so, based on that, there we go. Based on that, the mindset set shift that is needed is going from what is in your investment portfolio, what's in your pensions, what's in all your accounts, to looking into what is on your entire balance sheet. What is the range of assets that you have? What are different ways that you can diversify, as well as liabilities? And I think Americans tend to be a bit better at this than British people, but there are smart ways to use debt, especially if you're able to take debt out at low interest rates. If you're able to kind of use if you're able to take out mortgages to basically optimize the amount that you can invest more. The way to think like family office is to just remember that it's always about the interest rates. And so what you want to do is basically take out debt at minimal interest rates, but also invest in assets with really high rates of return. So you're basically just trying to arbitrage between the interest rates of assets and liabilities. And and so a new framework just going beyond asset-based assessments of your portfolios. So going from the question of how much do I have is kind of looking into what am I actually solving for and what are the levers that I have to solve for this specific financial objective. And so, if I break this down into four components, so first one is basically return. And so this is like how much growth or income do I actually need? And so splitting that up into asset-based growth as well as cash income because if you have enough cash income to kind of support your own lifestyle, then you might as well be leaving your assets to basically accumulate more value over their lifetime. The risk as well is quite interesting to think about because a couple of things happen as you grow more wealth. So, and they kind of go in different directions, right? Because one is that you have a bigger safety net, but then the second is that you also have more to lose. So, risk is pretty much, it's very interesting because I think my generation saw like a bunch of crypto millionaires being minted because people were able to take these massive risks. But then we also saw people lose a bunch of money to like meme stock investing, etc. And so actually, if you have worked with wealth management companies, usually if you're doing investments, the main thing that they measure through the assessments that they'll give you is what is your risk appetite. And I think that dictates a lot about the strategy that you can take. In general, risk equals reward, but of course, like if you're going to be doing borrowing strategies, the amount that you can lose is significantly higher when you start to borrow. And I'll go into a bit about leverage and things to watch out for with using leverage, or that's kind of a fancy word of debt for debt, later in this presentation. Liquidity is also a really interesting thing to think about, which is when do you actually need cash? So liquidity is basically stuff that is either cash or can be converted quite quickly into cash. So when I'm doing financial planning at Moola, what we'll do is we'll split assets into liquid and non-liquid because if you're in a pickle, the best thing to do is to spend from your cash reserves, especially if they're like 0% interest. Then you can start selling stocks and bonds, etc. But then it's like you don't ever want to be in a pickle where you'd have to sell your house to cover like a short-term volatility. So like if you end up with unexpected medical bills, right, you want to make sure you have at least enough liquid assets that you can convert quite quickly into cash to cover those things so that you don't have to sell your house and car in a pinch. And then tax as well. So you're probably quite familiar with this, but you know, if you are able to optimize your taxes, that can be one of the best ways to end up with more money in your pocket. And there are certain tactics that you can use. So I guess like the most drastic one would actually just be moving to a low tax jurisdiction. But then there's also techniques like tax loss harvesting, where you can basically offset some of the gains from your investing to reduce your tax burden. So what I do want to stress is that these complexity is a cost. So there's no point in just like trying these like fancy levers for the sake of it. You should always keep in mind the objective of what are you actually solving for. And you know, these levers can provide advantages along the way to get to that. But I would say like don't do things just for the sake of doing them, right? So really think about the complexity, risk, cost, benefits of doing any of the levers here. Okay. So if you are a founder, you are probably familiar with this term cash poor. And so what that means is that like even though technically on paper and maybe even when you're doing your tax returns, you might be worth a lot, you might not be able to access that cash easily. So that's an example of low liquidity. So yeah, if I show you on the left, like if you are a founder, you might have 2.2 million pounds or dollars in your company. You might have a house, and then you might have some ETFs and cash. But actually, your cash, the amount of cash that you hold is like a very, very small proportion. I think it's like 3% of your entire holdings. And so that's kind of like a funny thing because like your peer group might look around at you and say like, oh, you're doing really well, you're wealthy. But then if you end up getting a random tax bill or emergency, you might end up just having to sell your stocks at a loss. And so basically having that liquidity buffer can help protect you from these situations. It can be quite helpful thinking about your assets in buckets of liquidity. And so I find time buckets quite a useful way of thinking about these things. And so if you think about bucket one is like immediate liquidity, and so that might be the cash that you might need in the next 1 or 2 years. And so these will be the cash and the stocks, like money market funds rather, and then like things that you can like very quickly pull out to cover those emergencies. Then you might have more liquid investments, and I'd put anything from the 2 to 5 year time frame in the liquid investment. And so some examples of goals that you might be saving up towards here might be something like if you're planning to buy a house in the next 2 to 5 years, you know you'll take out a mortgage, but you still need to put down like a 10% time deposit. So, sorry, not a 10% time deposit, just like a 10% deposit on the mortgage or some kind of deposit on the mortgage, like the down payment. So you will be saving up towards that. And so maybe it makes sense to have it in some safer, like public equities and ETFs, but you know that you will be able to sell it off, like not all at once, but you might have like a time period over which you can sell it off to be able to pay for that down payment. And the last one is a liquid capital. So that's kind of the stuff that you don't really want to touch for, let's say, 5 to 20 years. This is like really what you keep there. You don't expect to touch it at all. And then you just make that money work for you. And so the idea here is that you might be able to invest in private equity funds. You might be able to get a stake in a venture capital fund. And that's where, if you're a founder, your business would sit there as well. And so that's the stuff that you just don't want to touch at all. And the reasoning behind that is that typically these types of investments will do their work over a 10-20 year period. But if you try and pull out before then, you have like you'll just lose loads of money because they're not structured in a way for you to take that cash out. You might have heard in America, I think there's this phrase called buy, borrow, die. And so one of the underlying the idea behind buy, borrow, die is there's two things. So there's the use of leverage or debt, but it's also a bit of tax optimization. So if we just start with the debt part of that, or the buy and the borrow part of that. So the idea is that you would first invest in something that you think is going to grow. So you might invest in private equity or venture capital or public market stocks, and you think that in the long run they're going to grow. They'd sit in that low liquidity part, the part that you don't touch. And so even though you don't plan to withdraw anything, you think that, okay, maybe the private equity investment that I've done will double or quadruple in 10-20 years. And so you would buy that. The fund manager of that will kind of write up an annual report for you every year, showing you how much that asset or that fund has grown in value. And so on paper, you'll see the value of this growing. And what you can then do is you can do a portfolio backed loan on this. So that's called a Lombard loan. And so what the bank does, or I think Wealthfront even does this, but what the bank or financial institution does is that it uses your portfolio as collateral to make you another loan. So say I have 100K in a portfolio, they might make me a loan of, it depends on the bank, of like 30 to 50% of that value. And then they'll offer very low interest rates on that. So I think the lowest I've seen is like 1.5% on a Lombard loan. And what you then can do is you can take that additional loan and then start investing that as well. So basically, for every dollar you have invested, you get another 30 to 50 cents on top of that. And so for the gain that you get on the portfolio, that then multiplies by another 30%. So this is quite a nice way to increase your leverage and increase your gains. There are, of course, risks of doing this. So the risk of doing this is when the investment goes down. So this is a worked example of that. But then what can happen is that if you take the maximum amount, so say you are entitled to up to 50% of the portfolio in a loan, but then they'll have something that's called like a margin call. And so if they're saying that, okay, at any point, like you can take up to 50% of your portfolio value out, if the value of your portfolio drops, the amount that you're allowed to take out also drops. And so if you've invested in the same thing and like the amount that you invested also drops, you have to sell at a loss and pay back the lender. And so the warning here is not that like leverage is bad. It's not when used correctly, but the message is try and be conservative. And so just because someone's offering you like a certain amount, it's often safe to just go below that. As long as you don't get a margin call and sell off at a loss, you can still stay invested and the markets might recover. So, yeah, so another thing to consider is like not all assets will qualify for this. So in America, they actually tend to be quite risk tolerant. Even the lenders tend to be quite risk tolerant. So, for example, you can often collateralize your business in America, and they'll often accept the paper value of your business, which can also be really handy if you need to buy if you need to buy like a house or something, you could give the paper value of your business to the lender, and then they could give you cash for it, and then you'd basically pay the interest rate until you're able to pay off the principal. But then in Europe, for example, they're much less keen on different exotic types of collateral. And then the highest risk, which I just mentioned, is the forced liquidation. If you basically have to sell at a loss. I don't know if you guys heard about this Leopold Aschenbrenner. So he was like a hedge fund that invested a bunch into AI. And then because he'd borrowed like crazy amounts there, right? So like here you can get like with a individual loan, you could get like 30% of your portfolio out. He was taking out 400% of his portfolio value in loans, investing it. And I think like there were 5 days in which like he basically lost, he had a portfolio value of 45 billion. And I think within 5 days, he lost 35 billion of it and then had to sell a bunch of stuff to another fund manager to basically pay off the debt. So yeah, so that was like a crazy amount of leverage, but then you can still be forced to sell things at a loss. So, if we are looking into more exotic types of investments that you could do, yeah, these are the different things you can do, and I'll just go into each of them because I think they can get a bit mixed up. So, yeah, so firstly, private equity. So you've probably heard quite a lot about private equity. I think the main thing with private equity is they usually buy out established companies. They have billions and billions in dollars of assets under management. They're typically funded by pensions and sovereign wealth funds. So if you have a pension, your pension is probably invested in a bunch of private equity funds. And they tend to be a bit boring, to be totally honest. So in Europe, they'll often just like they'll try and like consolidate operations. So they'll just like pick industries. I remember like a couple of years ago they were doing dentists' offices. Now in America, I've heard they're doing a bunch of HVAC roll-ups. And so what they'll do is they'll just like buy a bunch of companies in similar industries and then try and consolidate operations to reduce the cost of running them and just increase profits. Venture capital, like in theory, it sounds quite similar, but it just because of the risk profile, the culture is just very different, right? So private equity, already profitable businesses make them more profitable. Venture capital is more like gambling, where they will pick a couple of companies very early stage and then hope that some of them do well. And they've got this term for this, which is called RTF, return the fund. And so their hope is that they might make 30 to 50 investments, and they hope that a couple of them will return the fund, like make enough profits for all of the other companies to fail. It tends to be like a longer. So actually, to be fair, the age of both private equity and venture capital funds is quite similar. So it's usually 10 to 12 years now, but the life stage in which these fund managers invest in is very different. And then the third one is private credit. Private credit's been having a bit of a interesting time recently because it got very hot 2 years ago, and then last year it kind of crashed, and now it's kind of coming back up again. And so these will be the types of lenders that will lend to companies typically. So they will basically make loans to companies and then sell those loans to investors. So, they might give a loan out to a company, and then the company has to pay the private credit lender, let's say 10%. But then the way that the private credit lenders get that money is they'll raise from investors. A lot of private equity firms are now going into private credit. And so they'll basically capture the interest rate that they make back from the difference between what they get from the company that they made the loan to, minus the interest rate that they have to pay to the lenders. The next one, sorry, is secondaries. I love secondaries. I think they're really cool. And the way that this works is in venture capital, you usually have to be like quite a big company to make an investment into these funds. And so if we're thinking about like usually quite hot companies, like let's say early stage, they will make a check. The venture capital fund will make a check of like 500K to a couple of million into any one company. Now, if someone like you or I wanted to get into one of those transactions, say SpaceX, so I did like SpaceX or OpenAI, where it's like, okay, like they're not going to look at me if I don't have like at least a couple of 100K in my investment. What secondaries do is they basically they pull together investors to buy stakes in that company. So say the minimum investment size in a hot company like SpaceX 10 years ago was 100K. They could pull together 100 individual investors who are willing to put $1,000 in each. And then that's called a secondary transaction because they have like a VC firm usually in the middle that kind of splits out the shares that they hold and sells them to investors like you or I. And then the last one is real assets. So this is typically infrastructure, real estate, renewables. It can also be fun things like art would be a real asset. We could also make a category for alternative assets where anything not covered by the above falls in. People are investing in art, wine, whiskey, watches. And so, yeah, there's basically like many dimensions in which you can invest. And so, why might you think about doing this? So, you might typically, so it depends, right? Because I think 10 years ago, a lot of the private market opportunities were just better than what you could get in the stock market. So 10 years ago, like if you were investing in these private companies, then you would see like a lot of valuation increases. Actually, public stock markets have been doing so well in the past couple of years. I'd say that from a pure investing to grow wealth perspective, like there's not a huge reason to go into private markets. But the reason why you might invest in these is because you just think the companies are interesting and you still might expect some growth from them. Or if you want to have a stake in something that you think will have a massive growth. So things like, yeah, OpenAI, Perplexity, SpaceX, Anthropic, you still can do quite well from them. And usually the only way to access them is to go through secondaries. But they're not necessarily better if you get locked into a fund. They usually it's like 10 to 12 years being locked up. In them, you can't exit beforehand without paying like excessive fees. They have high management fees because these are run by people. You have these fund managers who are traveling around raising money from pensions and sovereign wealth funds. The typical structure, they call it 2 in 20. And the idea behind that is that every year the fund will charge 2% of your capital to basically run their operations. And then when they complete the fund, they'll take 20% of the gains made by the fund in its lifetime. And the capital calls are really unpredictable. So what a capital call is that like you won't put all your money in at once. So say you're investing 100K, they'll usually have a period of 5 years when they'll just make capital calls and they'll just ask you for part of that 100K over the course of 5 years. But usually, like they do it kind of randomly because they'll only do it if they find a new investment opportunity to invest in. So you might just be hit with like a 20K bill the following month. The valuations are really not transparent. Like in the stock market, you can like look at a chart, you see when it goes up and down all the time. When you're looking at the private market valuations, it basically depends. You only really see the valuation when you see the next raise that the company does, and you're really relying on the reporting of the fund manager themselves. And so it can be you're not really getting a lot of objective information about what the valuation should be. And then you're because it's like very human led, there's a lot of difference between managers. So general partners are GPs is the name of the people who are like managing these funds. You get some great ones and then you get some who just don't perform that well. So, what you can do is if you are considering investing in like a private equity or venture capital fund, and often banks will offer these, and sometimes retail trading platforms start to offer these funds as well, where you can get like small stakes in these funds. So you basically can look into the GP's track record. So often they'll have raised a number of funds. They might have some kind of track record. So a couple of the private equity funds that I've invested in are Khosla, which is a VC fund led by Vinod Khosla, and Vista, which is oh, I can't remember his surname, but Robert something. But what you can do is you can read the fund name and it will usually tell you the number of the fund. So I think like it can be like 10, 12, 14, and that shows you that the GP has the general partner has like a history of raising funds, and so they must have done quite well. Otherwise, like no one else would be investing in them. You can also just look at each fund that they've raised and see the performance of the historic ones. And so this is actually quite nice because some of the older ones you can you can see already like they've closed off after 10 years a couple of their older funds, or they might have some valuations of their older funds. So you can just generally see how have they performed. Another really interesting thing to look into is like fee structures. And also what you can do, like if you're considering doing any of this stuff, you can just take all of the information documents and just feed it into ChatGPT, and ask ChatGPT to do the fee analysis for you. But yeah, that something to look out for is like layers of SPVs, because what that means is that I mentioned to you before that like you can have secondary sales, but what you can have is like you can end up with loads of layers of fund managers operating on top of each other, all charging their own fees, and you can end up losing like 30% of your initial investment just because like all of the middlemen are taking a cut of your investment fees. Let's have a look. So, yeah, secondary sales. So this is an interesting middle ground. And so what can happen is investors can need cash. And I have a friend who did he did economics at Cambridge, and he was like, yeah, secondary sales are usually when people get divorced, when investors get divorced. And so what can happen is that I might have invested in a company before IPO. I wanted to wait for the IPO, but then I have like this super expensive tax bill, or I have an expensive divorce, and I'm like, I just need cash. And so SpaceX hasn't IPO'd yet. It has now, but like, so SpaceX hasn't IPO'd yet. I have 50K in SpaceX shares. I think they would go to 100K, but I just need the cash now. So I would then find someone who's looking for the shares that I have, and I would sell those shares to that new buyer. And so, yeah, either it's the original investor, but sometimes founders will do this as well. If founders who are cash poor, like need some additional cash flow, they might end up doing this and finding an investor that they know to sell some shares to. So uh yep, I'll just do this. Okay, and then another, yeah, breakdown of fees again. So I mentioned the management fees, so that's the annual fees that the fund charges to the investors to keep the fund going. Performance fees is the 20% at the end of the fund's lifetime. Tax treatment is super important when you're doing these types of investing. Usually, when you sell the investment, so you might get dividends, but actually, dividends are not that common in private market investments because usually, like companies that are growing will use any additional cash that they have to grow the company. Capital gains is super important. So often, like if like your fund investment is about to close, in that year that you think you'll get all the cash back, you would want to look into capital gains tax treatment. And then the timing also matters. So whenever you sell for a gain, often you might try and delay the sale to the following tax year if you think it will move you into another tax treatment bracket. So another thing that this is kind of there's a book called The Haves and the Have-Yots. And so you probably noticed that like a lot of billionaires are moving around. I think in California recently they introduced a wealth tax, same in Seattle or in Washington. So yeah, so often for the very, very wealthy, it will just make sense, financial sense for them to move to a different state or even a different country. Um, the advantages that low tax jurisdictions will usually use to bring people in is reducing either the capital gains taxes or the income taxes. The other really interesting thing is the estate and succession planning benefits, and that's actually the last part of the buy, borrow, die. So because um, inheritance tax in the US, like if you've done the buying, the borrowing, and you have like quite a significant amount of capital, you don't necessarily want to sell the investments you have at the end of your life to pass on because then you get taxed on capital gains. In certain places where they don't have inheritance taxes, it might make more sense for you to leave the assets to your successors in your will because then they don't get the capital gains tax and the 25% that you would lose by selling the investments doesn't get deducted. So you're able to save quite a bit through smart tax planning. And then you might also get the enhanced asset protection. Um, some places also just have weird quirks. So I'm tax resident in Germany, which does have high income tax and capital gains. But they have this weird rule that if you hold on to crypto for more than 1 year, you don't get taxed on it. And so that actually makes crypto investing in Germany quite beneficial. So some of the things that you might want to think about are the substance requirements. So a lot of places will have residency requirements. Um, these range. So I think there's a lot of Caribbean islands, and I think you basically need to spend 90 to 180 days there per year. I think Dubai, you only need to go twice a year. In America, FATCA is very, very strict. So, yeah, so they can basically request reports from those specific countries to basically show that you did actually have a real economic presence in those places. Reputational risk, I think this is a big one. So the billionaires get a lot of shtick for moving around to protect their wealth. It is complex, it is costly. There are a lot of administrative fees, hiring new tax advisors, and then legislation changes as well. Even in these low tax jurisdictions, things can change year after year. And so it's like, even if you choose to do this, you might have to do it again. Having said that, I think that I have seen people who are not billionaires use this quite successfully. For example, digital nomads, a lot of people will just open a company in Dubai and they're just freelancers, but then they can use that kind of structuring to support their freelancing activities. I've heard Paraguay randomly also does similar things like this. And so it can actually just be quite a nice tool to also become a bit more financially independent as well as be able to just live in nice sunny countries. I've got a map here. I think I won't go into the America ones because I think there's just like a couple of states that do it. The foreign ones, so Cayman Islands, massive for crypto people, Switzerland, Hong Kong, and Singapore. And then Luxembourg is the big one in a lot of funds are actually structured in Luxembourg as well. So,
Linda, really quick, I just want to encourage folks. We have about 18 minutes left with Linda. I know we're going through so much incredible and helpful information. I want to make sure if folks have questions that we have a moment to get those answered too. I know a couple people have been sending some comments and questions in the chat, but just want to encourage folks to think through if there's anything that Linda has mentioned that's sparking questions for you. Feel free to send them in the chat. And then, Linda, whenever you're ready for us to pause and take some questions, just let us know and we can dive into them.
yeah. Should we take some now? Because I can't see the question. So, yeah, yeah.
Okay, sounds good. So, uh, Erica, you sent over a question a little bit ago around how much cash folks should have in reserve. If you want to ask that live and chime in, please feel free to.
Hi, Linda. Thank you. That was interesting. Sometimes I just feel like there's like this whole cheat sheet that we all should know, but yet we don't. So that was helpful. Thank you. One thing that you were talking about was leverage, and I think that's something that I struggle with because, it's like if you're trying to have emergency funds or reserves, but yet at the same time, you're just looking at this huge pile of cash, 100 grand or whatever it is that, do we just keep that in like a high yield online savings account so that it's at least earning something? Or do we somehow, you know, go put it into real estate? I think somebody else asked about real estate, which is what I have been recommended to do, but then it's like you don't have those savings anymore. So I think that's something I would love to hear your thoughts on, without getting over leveraged, but
Mm.
also not letting you just have like a ton of cash sitting there that could be actively growing.
Yeah. Yeah. So typically they recommend 6 to 9 months in like cash or yeah, high yield savings account, money market would be a good one. And so that's kind of like just leave that there, to be honest, like try and get some interest rate on it. But then like if you need to pull it out, you need to pull it out. I would actually say that in America, because health costs are higher, I would anchor it more to like 9 to 12 months of family living expenses. And then on the extra cash, I don't like real estate personally. I think like it's good to have a roof over your head. It's good to have the financial stability, etc. But as secondary houses, buy to let, etc., like it just takes so much management effort. It takes a lot of time, it takes a lot of energy. Real estate value is not going up as much as it used to. So I think the advice that like yeah, if you throw your cash into real estate, it'll be safe there, isn't actually so true anymore. And in the UK, the pace of inflation is actually
Mm.
higher than real estate appreciation. And you still have to deal with all of the like stupid like fixing pipes and like renting stuff out. So the I did my MBA at Yale, and I remember the real estate professor was like the only value of real estate is like the joy that you get of living in a place. And so like secondary homes, like yeah, maybe if you're using them for holiday homes, but is it actually worth owning it? Maybe not. Like I generally prefer flexibility and liquidity, but that's a personal preference.
Hmm. Yeah. Okay. Thanks.
Linda, I feel like you also touched on this in little moments, but I feel like it could be helpful to also directly ask, like, at what stage should people be planning and thinking about these various things? Like, what do you find helpful as like moment of action? I'm
Yeah,
curious about that, particularly in the lens of like tax planning that you were just talking about a few minutes ago, but
yeah,
if you have like a general thought on it, that's super helpful too. And then Stevie, I see your question in chat. Please feel free to unmute and ask as soon as Linda answers.
yeah. I think basically like if you get to a point when you're like, I have more money than I know what to do with, which is kind of ironic because it's like, yeah, again, it goes back to like the Maslow's hierarchy of needs, right? Because it's like if you don't have much money, like you have to stretch your dollar to like make the most out of it. So some of the people that I've interviewed I remember I interviewed one woman and she was like a single mom. She had her kid quite young. And then later in her life, she became like quite wealthy through her work. And she was talking about the challenge of like going from that scarcity to abundance mindset. And so it's a bit ironic because it's kind of like once you've solved for your basic needs and you're kind of like looking at your portfolio and you're bored of the stuff there, then it's like, okay, like it's almost like if you're kind of you have all the basics sorted, you've got the investments going, and you kind of want to extend a bit more to support a very specific goal that you have. Mm.
Thank you, super helpful. And then Stevie, do you want to go ahead as well?
Sure. Well, so I had asked earlier also about real estate, and then you're like, "No, I don't like real estate," but I'm still gonna, I want to talk about it still. Uh, okay, so, um, I'm very interested in real estate. I live in California, and I feel like, even if it's like you have something, even if the investment doesn't pan out, I don't know, it just feels like there's a tangible, like you own the land. And
Mm.
so even if like for example, if it was commercial real estate, like okay, well, I still own the land, I could still do something else with it. Or I still have the house, like someday my kid could live in it. So anyway, that's just like my perspective. But basically, I had heard that if I already have my mortgage, I already have my savings and like emergency fund and retirement stuff going, that I could leverage the assets, like the cash sitting in one of my businesses to get a second mortgage on another home. Is that true? And like, what should I think about with that?
It might be true. It depends on the lender, right? So it depends on how much risk the lender's willing to take. So it's kind of like a conversation between you and your bank. And if your bank won't do it, like there might be another bank that does. The risk of it is basically that if your business devalues, you might have to like sell the house even if it's at a loss. And also
Mhm.
because like when you're doing a house up, like if you think of renovation costs, etc., like if you have to sell the house back, you might not get the renovation costs back. So you might end up just like losing quite a bit on that. A really interesting story is the Peloton founder. So the Peloton founder basically, like, during COVID, I think the company was worth billions and billions. And he did this where he collateralized his shares in Peloton and bought a house with it. But then the value of the shares sunk. The bank was like, we want our money back. And so he had to sell the house that he and his family were living in to pay back the bank.
Hmm, I
Yeah.
see.
So again, like quite a extreme story, but like it's quite a good example of like what can go wrong.
Totally. And then my second question was, what are your thoughts on real estate investment trusts?
Right. Yeah, I guess so. The benefits there are that, yeah, you don't have to manage it because you have a fund that does. You get the diversification, but the fees are super high because
Mhm.
in addition to someone like managing the fund, like if you think about like all the cash that gets lost along the way, like there will be some amount of the money that you invest that goes into either the building, development, renovation. So you have to kind of really believe that the right is going to like outperform compared
Yeah.
to the cost that you're putting in.
Okay. Thank you.
Yeah. Yeah. Are there more questions? I've
Not at
also
this
just,
moment. Definitely
yeah,
encourage folks, given we're in our last 10 minutes, to feel free to just even raise your hand if you have any questions. That way we can be sure to see it and make sure we get to it. Otherwise, Linda, in the meantime, I'm going to turn it back to you. I know you have some more information to be sharing with us. So we're excited to learn more. And if folks have any questions as well, I want to make sure that we get those answered. Back to you,
sure.
Linda.
Sure. So next one is tax loss harvesting. And so this one's actually really counterintuitive because it's like it basically means that like you sell stocks at a loss to reduce the tax burden of them. So if the example here is that you have two positions worth 100K and then one rises and one loses, you might actually want to sell your investment in B so that your tax burden decreases. So instead of like a 30K gain alone, you only make a 5K gain. Now, the thing that you have to catch as well is that you do have to reinvest the investment B amount, like the amount that you lost, into something that you think will actually increase later. But then the idea is that, like, when things fall, you're kind of taking advantage of the fall and then reinvesting in something that you think will gain again. But then, like, the amount that you lose isn't actually lost because you're reinvesting, but you're just using it to offset your taxes. So we've gone through a bunch of things here, and I'll share the slides afterwards so that you can refer to it later. But then the idea that I really want to stress again is that like it shouldn't be your goal to just like use all these fancy instruments and things for the sake of them. It's just like figure out what you're actually trying to solve for and figure out what actually best suits you and your personal goals, and how you can best optimize. Complexity is not good for complexity's sake, but there are things that exist that can help you be creative. So I've also got this checklist of what you might go through whenever you're considering a new strategy or investment opportunity. So again, what is the actual objective? Then secondly, what would be the financial, actually, let's not even say financial return, but what return am I expecting? One economic principle that I love and go back to is called utility. And utility is basically like the happiness or joy you get out of something. I invest in art, so I actually did an interview with the Art Journal a couple of weeks ago. And so I use this example because I was like, I don't invest in art because I think it's going to make me loads of money. I invest in art because I like it. And sometimes I know the artist and want to support them. And it makes me happy seeing the stuff on my wall. Similarly, as well, with the utility argument, with the housing argument, it's like you might buy a house because you want to raise your kids there and you will make a lot of happy memories in that house. And that the value of that happiness can sometimes swing the argument across the way of something that might not just be a purely financial investment. Angel investment, sometimes I'll invest in my friends' startups, not because I think it'll make me really rich, but because I like what they're doing and I want to support them. Next question would be like, what happens if I'm wrong? What's the worst that could happen? Um, Fourth one, when can I get my money back? When will I need my money back? Fifth one is about like how much is the actual like operations of the investment costing? Six, how does this match the rest of my balance sheet, my assets, my debts? And then seven, like, can I do this? Can I get from A to B more simply? So, yeah, so these are effectively the goals of investing. Once you've kind of got into the position where you're like happy to kind of experiment a bit more. And yeah, I think I'll actually just skip past these because I've seen there's a couple of questions. Are there a couple more questions or?
I see some folks who had to leave just a couple minutes
Okay,
early for 1 p.m.'s or for 2 p.m. Easterns, Linda. Um,
awesome.
but definitely want to hear from you around what you think is most important for people to be taking away after this session.
Sure.
So looking forward to that. And for folks who do need to sign up a minute or two early, I'm just sending a quick note in the chat to thank you for being here and also sending both an event feedback form and event submission form for folks who are interested in doing their own one of these. Linda, this has been so awesome so far and extremely informative and grabbable. So we'll send it back to you for our last few minutes and for a wrap up. But in the meantime, just want to express a lot of gratitude too.
Awesome, thank you. So, yep. So, something that I'm gonna look into is like scenario planning and just looking. So, this is the example of like what are the worst things that can happen. And so you can stress test your portfolio by asking what would happen if the markets fell, what would happen if your company has to do a down round at a lower valuation, and then that affects the loans that you've taken out on your business. And then what happens if you actually need to buy your property sooner rather than later and during a pinch for cash? So, yeah. I think I will leave it at that. Um, yeah, if you are interested in trying any of these scenario planning, so we have built our platform for that. Would be very happy for you to try it out and send the feedback to us as well. And yeah, I think that's it. Basically, good luck with your investments. Feel free to contact me anytime as well. And happy for any final questions.
Amazing. Okay, I see some claps coming in. Thank you so much, Linda, and definitely encourage everyone to send some dreamers and doers hearts and congratulations and thank you to you, Linda, for doing this. What I'm going to do is just go ahead and re-up some of the links that I just sent around sharing some feedback and thinking about doing your own session like this one in the future. Linda, if folks have questions, what's the best way to stay in touch with you?
So I am available on LinkedIn, and yeah, I think LinkedIn is good, and Moola as well on the website. I think I should have my email address. Yeah.
Okay, brilliant. That sounds wonderful. Thank you so much, Linda, for doing this. Thank you, everybody, for joining, and hope folks have a beautiful summery Thursday.
Thanks so much.
Bye, everybody. Take care.
Bye bye.